Reserve Bank of Australia makes its first rate decision under the stewardship of new Governor Michele Bullock today. There are nerves that pressure is growing to increase interest rates again. Our business editor Ross Greenwood joins us. Ross, economists are expecting one more rate increase. When, this year?
Yes, probably in many cases it's divided. Really, many of the economists have got really mixed views as to when interest rates or whether they'll rise again this year, and indeed when the first interest rate fall will come. Many of them had even penciled in as early as late this year that there'd be an interest rate cut here in Australia as the economy slows. But many of those have now put those back until mid to late next year, when eventually these interest rate rises do catch up with Australia's economy. So today is the first decision by the Reserve Bank Board under the stewardship of the new Governor, Michele Bullock. Now, not only is there going to be, if you like, the markets are saying no change. You can see here 96% chance of no change according to the money markets, but it's going to be the language, the rhetoric that Michele Bullock herself comes out with in her own statement to see whether there's any tangible change, because we know there are different pressures coming right now. Last week, inflation numbers were higher than expected. We know also that even jobs numbers are continuing to be strong, and Michele Bullock previously has said she believes that the natural rate of full employment in Australia is not where it is now at 3.7%, but probably closer to 4.5%. But under the new mandate of the Reserve Bank, it is likely it'll have an equal weighting to fighting inflation and also fighting the unemployment rate, trying to keep employment as full as it possibly can, which is going to potentially even create conflict about interest rate settings in the future as well.
Okay, so how are markets reacting to all of this?
Well, interestingly enough, not only here, but around the world, money market interest rates have been rising and rising fast. We're going to take you through just a few of the numbers to give you a little sense of the fact that these pressures are on interest rates. So if you're a borrower, you're a mortgagee holder, for example, it's one of these situations that you are not yet out of the woods in regards to interest rate rises. Here's the one-year bond yield. Now, it's down a touch today, but broadly has been rising, almost 0.5% higher over the past 3 months or so. And that gives you a sense as to where the market thinks the rates are headed. In other words, higher, 4.2%. If we go to the longer term interest rates, this is actually instructive. 4.5% is the 10-year bond yield. Again, that's a little lower today, but broadly it's higher over the past 6 months. In fact, that rate is almost 1 percentage point higher than it was going back about 6 to 9 months ago. Then we come, say, for example, to the Australian dollar, which is under some significant pressure right now, 63.6 US cents, and that's because in the United States, again, there's suggestions that there will be further interest rate rises. If there's a gap between Australian rates and US rates, well, then that certainly will put pressure on our Australian dollar to fall. That, of course, means your petrol prices, your imported prices, they keep on going up. It adds pressure to inflation here. And here's the ASX 200, down 1.5% today, and that is all on these interest rate fears and also the fear of China slowing, all things that eventually will catch up with the Australian economy. So it's that Michele Bullock and the Reserve Bank Board will be juggling when they're meeting right now to make this decision this afternoon, Australian Eastern Time.
Yeah, looking forward to that, Ross. Of course, you know, we like to look a little bit further ahead, and there's a lot of crystal ball gazing going on. We're still keeping in the back of our minds that economists have been talking about a rate cut. That's not going to happen for quite a while, is it?
No, it's true. And so if you go and look at all of the economists, and they are so mixed at the moment, this is one of the really interesting things. There's no general consensus as to where the economy lands and when it lands. And so therefore, many people thought really the economy would be slowing really significantly by now. And so that would lead to lower interest rates by the end of this year. That now is pretty much off the table with most economists. They now believe that the first interest rate cuts won't come until next year. The problem, as you can see, is with the housing markets. A lot of people have jumped in anticipation of rates being cut potentially this year. They've been looking to jump in ahead of the stimulus that will come when interest rates eventually fall. But the more that that's delayed, the more that there's going to be issues or question marks about A, the labour markets, B, the economy as a whole and company profits, and then finally into those property markets. Because the one thing you wouldn't want to see is rising unemployment, because if rising unemployment occurs, that's going to take some demand very quickly out of this housing market, which now is back at record levels in most capital cities.
Ross, a lot to take in there. Thanks so much. I'll see you soon.
No problems at all.